How many of you like to pay taxes? Okay, now that's not the right answer, guys. I mean, you want to be paying $1 million a year in taxes, and me doing your tax return. That means you're making a lot of money. Okay. In fact, we were talking this morning with the gentleman that Dr. Ross met with, and he was kind of complaining about paying taxes and stuff. And Dr. Ross told him, he says, well, now Joe Craft told me when I first met him that if you're a minister, a farmer, and you're involved in network marketing, you won't pay any taxes. And you know, that's kind of a joke, but there's some truth to that, because there are some extraordinary tax breaks for all three of those types of taxpayers, and the one we're focused on today, obviously, is the home-based business. So let's look at a few of these criteria just to kind of give you a flavor for what the profit motive requires. And this is on the second page. The first one, the manner in which the taxpayer carries on the activity. Basically, all that means is you need to run it like a business. Okay, you need to keep the proper records. You need to make business decisions. You don't need to treat this like this is a thing. Okay, you need to take it seriously, and that's what they're going to. That's how day's going to be spent talking about taking this seriously and working it. And if you do what they tell you, you will meet this test. Okay. The second one, expertise of the taxpayer as advisors. So you want to attend every training. You want to be on all the calls, all of that stuff, and you want to document this. Okay, these are all the things I did, and you'll meet that test. The third one, time and effort expended by the taxpayer in carrying on the activity. No matter whether it's 1 hour, 5 hours, 10 hours, full-time, whatever per week, you want to keep a record of that. Obviously, the more effort you put into this, not only the more money you're going to make, but the better off you're going to be on meeting these tests and qualifying for these tax breaks. Okay, the next one, success of the taxpayer in carrying on other similar or dissimilar activities. Okay, if this is your first home-based business, fine. Everybody's got to have a first one. But if you've been in other ones before, that helps you, because you want to be able to show that this is, this is what I do and this is what I'm good at. So, taxpayer's history of income and losses with respect to the activity. Now, this is one that the IRS really does pay attention to. I kind of cringe when I see somebody that's been in a home-based business for 10 years and every year they show a loss. Eventually the IRS is going to catch on to that, okay? Like I said before, you can't do this forever. But if you work the business like these guys are going to teach you how to do, you'll be making so much money that you won't be able to show a loss anyway. So that's what you need to do. The amount of occasional profits earned. And all this is there's a kind of somewhat of a myth. You may have heard this before, that you need to show a profit in at least 3 out of 5 years. And that is kind of thrown around as kind of a rule of thumb. But what they're saying here is you don't want to show a $10,000 loss, a $10,000 loss, a $200 profit, and then go back to showing a $10,000 loss. So that's kind of what they're talking about here. The financial status of the taxpayer. If you are working the business and this is what you do full-time, and you happen to be married to a wealthy surgeon, I'm going to pick on you, then the IRS sometimes kind of says, hey, are you just doing this to help him save on his taxes? Of course, that's when you get a guy like me involved, and I'll argue your case for you. But that's kind of the gist of this case. So, I mean, for most average Americans, that isn't even an issue, okay? You're both working it, you both got jobs. That's number 7. Number 8, elements of personal pleasure or recreation. I don't think this really applies to this type of business. This is more for people that are raising horses or racing cars or some expensive hobby that they're trying to call a business. I'll argue with the IRS all day long that this is not a hobby. You know, this is a legitimate business. And finally, expectation that assets used in the activity may appreciate in value. And all these, I didn't make this up, okay? This is something that's been developed over the years through case law, and this is kind of now what the IRS uses as their standard. But in this issue, this is a slam dunk for network marketing because your business is transferable, it's willable, it's sellable. So as the income of the business goes up, it has an inherent value. So as your income goes up, your business becomes worth more. Slam dunk, you can meet that. All right, so that's the profit motive. So that's the first, there's two things they look at. That's the first thing they're looking at. The second thing is that all of your expenses that you claim need to be considered what they call ordinary and necessary. Okay, that means they're ordinary to the industry and the type of business you're conducting, and they're necessary to the specific activity. So I'll give you kind of an egregious example of what would flunk the ordinary and necessary test. If you're in network marketing and all of your business trips are to Disney World, okay, that's not going to work, okay? I can tell you. Been in there, I know that didn't work. Now, if you're going to, if the annual convention's in Orlando, certainly, and that's the trick. You need to combine what you do every day with working your business. Okay, for your expenses to be deductible, the principal purpose of the expense has to be working the business. So if you go shopping, you don't say, I went shopping and I passed out some cards. Your mentality needs to be, I went to work out my business and I bought a few things while I was out. See what I'm saying? Okay, it's all about intent. And you have to develop the mindset. And I can tell you, I've had some audits of some taxpayers that I've represented, and when they get on the phone and this is why I usually don't want my client talking to the IRS, but that some of them have got on the phone and they say, well, everything I do is business. The IRS just sends shivers down their spine. You don't want to say that, okay? What you want to say is that I spend all my time working my business. And these things that I do in conjunction with working my business, some of the expenses that I spend in pursuit of that become tax deductible. So, and you need to keep good records, okay? That's the other point. I've always said the person with the best records and receipts wins, okay? No doubt about it. And there's some rules you need to understand. Okay, first of all, meals and entertainment expenses. The regulations say you have to document this information, I'm going to tell you, within 24 hours of the meal. All right, you got to document the date, the amount. Well, those are already on the little receipt that the server gives you, okay? The date, the amount, who ate, and what the business purpose was. So what you do is when you're putting the tip on the little slip for the server and you keep your copy, just take it right then and write down who ate and that you were talking to them about your business, okay? That's all you got to do, and then you save that. And I've had some people that they flunk the 24-hour rule simply because they're ignorant of it. And you've heard Dr. Ross talk about the difference between ignorance and stupidity. This is pure ignorance, okay? And that this really trips taxpayers up because they don't know there's this 24-hour rule. A lot of them will just come in and say, well, here's my bank statement, here's my credit card bills, and you can see I went to Applebee's on this date, O'Charlie's on this date, whatever on this date. That flunks the 24-hour rule because they know you didn't write all that stuff down within 24 hours. That's why you have to save those little restaurant receipts when you walk out. You've got to just take them home, stuff them in an envelope. If the IRS comes and knocking later, then you got it. But just being able to give them 12 credit card statements isn't going to meet the 24-hour rule because you didn't do that within 24 hours. Okay, so that's important. Another thing is mileage. Now this, you do have the right to reconstruct after the fact. You got to keep 4 things again. You got to keep the date, the destination, the number of business miles, and the business purpose of the trip. Those 4 things: date, destination, number of business miles, business purpose of the trip. And you need to be somewhat specific on the business purpose of the trip, because I've been in situations before where the person just wrote prospecting or passing out cards. They didn't say where, or I even had one auditor what time. I want to know what neighborhoods you went into, you know. So again, you know, plan for the worst here. The best policy is document, document, document.